Hello, listeners. Welcome to another episode of the Jacob Shapiro podcast. I'm going to warn you from the outset. I'm in travel hell right now. Flights got delayed. Flights got canceled. I had to record this episode from an airport lounge in Los Angeles, which is not where I should be right now. I'm supposed to be somewhere else in California giving a speech. It probably will be, but I have to rush there right now too. So my audio quality is not going to be great. I have not had a lot of sleep. I'm all over the place. But Rob and I have kept missing each other the last week or two, and we obviously needed to get an episode together out with all the things that have been happening in the last week. In some ways, like, it's the culmination of the things that Rob and I have been talking about for 2 to 3 years, like all sort of coming to a head. So please forgive me for the audio quality and for any scatterbrainedness that you pick up from me, because I'm all over the place right now. But Rob was in good form, and I hope that I at least kept pace with him a little bit. You can email me at jacob@jacobshapiro.com if you have any thoughts, questions, comments, concerns. Otherwise, be careful out there. Take care of the people that you love. Cheers, and see you out there. All right, listeners. I'm not going to spend that much time ranting about where I am right now. Rob can see me. I'm in the Centurion Lounge in the Tom Bradley International Terminal of Los Angeles, the Los Angeles airport. I'm here because American Airlines sucks balls. And I will be coming for you, American, for not only a refund for my flight yesterday, but also to compensate me for the other flight that I had to book just to get to my event on time. Long story short, long delays. No, the thing that really galled me, just play therapist for a second. No one even apologized or told us we were going to be late until 30 minutes before we landed. Like, not the pilots, not the flight attendants. When I got on the ground, I sprinted to my gate. Technically, I was there 7 minutes before it was supposed to leave. They closed the doors anyway. They treated me like I was, some kind of disgusting vagrant. Like, how dare you show up here 7 minutes early before the flight leaves and expect to get on the plane, sir? Anyway, sorry. Just get off my lawn, American Airlines. Never flying y'all again.
Well, this is America. You don't have to apologize to anyone anymore.
Yeah, I guess that's true. Okay, but enough of my ranting about travel. If I seem a little unhinged, though, it's because not a lot of sleep here in the last 2 days. Rob, we've had a chance to catch up with Marco a few times on the podcast recently, but our schedules have been, crisscrossed, and I was determined not to let American Airlines spoil that too. And the listeners have been asking for you. I haven't even told you that. I've been getting multiple emails. Where is Rob? We need Rob. And I also have not had a chance to catch up with you for a super long time period. Yesterday, listeners, Rob and I were on a board call, and literally during the call was when Trump came out and announced the 90-day pause. So like, Rob is like trying to field questions in this call about like marketing and things like that. And the NASDAQ has gone to like 10%, up 10% or whatever crazy thing it was, and all these other things happening. So it's literally a crazy week. The place, Rob, where I want to start, though, is I posed this question to Marco, and it's the question that's in the back of my mind. And I think you'll be able to help me get off the ledge. And hopefully it's a nice doorway into talking about sort of what's happened in general over the past week and what it means going forward. I rewatched Margin Call with my wife a couple of weeks ago because Megan hadn't seen Margin Call. And there's that scene where the young researcher is presenting the research to Jeremy Irons, who shows up at 3 a.m. And he basically says, I'm paraphrasing, I have one job. It's to listen for the music. And if the music stops, I have to make the big decision. And I don't hear any music at all. And I confess, it was not the whole of my being, but like 10 to 15% of me was like, yeah, these are the highest tariff rates since Smoot-Hawley. And this does seem like a really big policy misstep. And he announced tariffs, but the dollar is weakening and treasury yields are rising and fear is rising. And, as I said in that piece that I put out, my daughter's daycare teacher, when I went to read to their class, was like, what do you think about the market? I'm watching my retirement. Like all of that, I was like, is the bottom about to fall out? Like, we're worried about down 10 to 20%. Is this a Great Depression level type event if they don't veer off? And of course, then Trump veered off. But I guess the first question I wanted to ask you, and take in whatever direction you want, is, do you still hear the music? Is the music softer? Is it louder? Is there no music? Like, how would you take the 15% of me that was literally shitting bricks earlier this week?
Well, the margin call comparison is an interesting one because really what that's a reference to is to Chuck Prince, who was the CEO of Citigroup at the time, who famously said, as long as the music is playing, we have to keep dancing, and the music is still playing. And really what that's a reference to, even though I don't think he wanted to be so explicit about that, is that the 2007-2008 crisis was a crisis of essentially Ponzi finance. It was a financial crisis. Um, a massively over leveraged financial sector, um, making the wrong assumption about the value of the collateral underlying that leverage. That's a very different situation from what we're in today. I don't think the music metaphor is particularly apt. There's leverage in the system. There's plenty of overenthusiasm. There's plenty of, especially around AI, certain areas like that. But for the most part, if you look at the actual balance sheets of market participants, especially the formal financial sector, all of that leverage has come out in the last 15 years. And actually, that's one of the reasons why banks have been outperforming since Trump was elected, is because they've been really kept on a tight leash since the financial crisis. And a lot of people in the industry are making the claim that they should be let loose more. That, I think even Scott Bessent himself said, the financial crisis was 15 years ago now, or 20, it was a generation ago, essentially. So the music has not been playing in the bank sector for quite a long time. Um, and this was a fundamentally different sort of scenario. This is not a financial crisis. We are not going to have a financial crisis like we had in 2007, 2008. I mean, I think that's a very high probability. I'm willing to go out on a limb like that because there are not sources of systemic risk like that, really, that people can identify right now. Now, people have talked about leveraged hedge funds and basis trades in the last week. And yeah, some of that is going on. But in terms of scale relative to that time, in terms of like hedge funds have been tamed as well. The hedge fund industry is a shadow of what it once was. There are these pod shops that have gathered a lot of AUM and they do run leverage books, and there's sort of risk models that get used there that, use a lot of sort of uh, very active methods and leverage to 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 manage things from a portfolio standpoint, but it's very small potatoes. None of this stuff is really about leveraged finance or Ponzi finance, and therefore music doesn't really come into it. The music is the stereo has been turned off for 15 years. This is something totally different.
Okay. Well, that's heartwarming. Is there a negative case though? And I'm also struck by, depending on when we recorded this podcast this week, we would have probably had a radically different perspective, because early in the week it would have been the sky is falling, and then there would have been the brief moment where it would have been that brief moment where things had turned around and everything was up again. Now, this morning we're recording, it's, what is it? It's, I've lost all sense of time and space. It's 8 a.m. here, Pacific, in Los Angeles. Market's down about 2 to 3%. So it's markedly different how you would view it based on where you are, like what day we literally would have been on. And I think this is one of the, we talk about financial media all the time, but it's almost like they don't know how to deal with Trump, because it's like, oh, there's a crisis, there's not a crisis, there's Liberation Day, there's tariffs, there's no tariffs, it's China, it's this, it's the basis trade. Like, it's like every single day is something new. So if we're trying to give listeners a narrative for what's happening, because I do think it's entered the zeitgeist. I think there's been enough market volatility that even your normal person on the street is like, what the heck is going on? Like, if the stereo is off and it's not financial crisis, like, what's the narrative that you're constructing right now?
Well, it's definitely a crisis. It's just not a financial crisis, and it's definitely very, very grave what he did. Just to be clear, like the tariffs are not a small thing. And there's a lot of uncertainty around that, and that's the word I would really highlight. The only thing certain in all of this is uncertainty, and that's really important, and let's put a pin in that and come back to it in a moment. But I just wanna point out that on the tariff front in particular, speaking of uncertainty, that's one of the things that is just so hard because we just don't know. We don't know what the impact is if you implement tariffs like this right away. And we've talked about this, toward the end of last year. We spoke about, how do tariffs work, the different mechanisms, how does this actually play through? And we were talking about much smaller numbers. These were astronomical numbers and globally. So very different ball game. Definitely will have an impact, but the problem is historically there's just no good comparisons. So the only times we've had something like this, we had Nixon put on 10% across the board tariffs in 1971, and they lasted a few months. they didn't have a huge effect. It wasn't a big deal. There was a lot of other volatility going on in the economy, so kind of a nothing. And then the Smoot-Hawley tariffs, which are so famous, but of course, they were put on in the midst of the biggest financial crisis deflationary event that the world has ever seen. So it's like, if you're falling off a cliff and shoot a gun in the air, what is it like, who knows? It's really hard to take anything away from that. So the point is we have no idea what would have happened because markets behave in unpredictable ways and people behave in unpredictable ways. So getting back to pulling the pin out of the uncertainty, and I think this gets to, okay, has anything changed between now and 10 days ago? Some people will say, no, oh, this is all just a lark, whatever. I think that's a very wrong interpretation. I think if you look at markets and where they are today versus before, the S&P 500 is, somewhat down, but that's not what matters. What matters are 10-year bond yields, and what matters is the dollar, because those are the gauges of credibility and the gauges of uncertainty. In particular, I'd point to bond yields because between now and before, the difference is now market participants are factoring in a much higher chance of recession. Tariffs or no tariffs because of the uncertainty that's gone on. And that's really the key is like uncertainty kills investment. No one is going to invest. And we talked about this in terms of Trump trying to encourage domestic manufacturing capacity. No one is going to do that. They weren't going to do that before. But what he has done, we were talking about this internally because as an investor, it's so hard because it's the tariffs and the amount, it dictates so much about what happens in a company's financials. And sort of the takeaway that we had internally was the investment thesis is how do you invest behind uncertainty? Because that is certain, and that's where we are. And then there's a lot of implications that we can explore of that, but that's the key takeaway here.
How do you react to the reporting that what changed Trump's mind about the tariffs and had him put the 90-day pause on everyone except China? And by the way, my answer to the question of what's different today between last week is, well, there's a full-on, full-blown trade war with China, and maybe he wants a deal sort of in the long run, but like that's the thing that has changed, even with in addition to all of the uncertainty. But there's been a lot of reporting. Number one, like why were treasury yields going up, and reporting that, oh, the Japanese were selling treasuries, maybe the Chinese were selling treasuries, and that it was that point that Besant sort of imposed his will on Navarro and Lutnick and went to Trump and said, this is something is really wrong here in the treasury market. You're breaking it. There's also like the Wall Street Journal reporting that, Trump was watching Jamie Dimon and Jamie Dimon was talking about this. And he was like, oh, I know interest rates and I know why this is important because I'm a real estate guy, yada, yada, yada. He decided, and I believe his words were everybody was getting yippee. I think I'm quoting the president correctly there. Um, let's start with yields, and then we can get to the dollar. Why are yields going up, do you think? And what does that gauge tell us?
Well, the first thing you have to do in any discussion of bond markets is forget about the Chinese, the Japanese. Who the buyers and sellers are doesn't matter. And we've talked about this in the past that the United States does not need foreigners to finance our government deficit. We have domestically the largest and most liquid capital markets in the world. We have no problem financing the government debt with all the wealth that's held by Americans in America. So this is a common trope, and we've talked about this in the past, but I just think it's worth reminding people because the media always gets this wrong. Like if China goes and sells 3 trillion of treasuries tomorrow, like there'll be some market impact as that works its way through, but over the longer term, it's not going to matter. So that's point number one to make. Point number two to make is that's why this is so important, the change that you've seen in yield. So we've been talking about this internally and on the podcast, for the public, just this notion that yields have been acting very unusually. Even as growth expectations have been coming down, even before this, yields have not been coming down. And what that means, because yields should be coming down to reflect slower growth, a potential recession. The consensus was moving toward recession even before this happened, and yields were not following lower. And what that means is that inflation expectations long term are rising. It means the uncertainty, the risk premium in long term bonds is rising. And those are the two most important kind of takeaways to bring from this. Because if you look, take a snapshot today, compare it to 10 days ago, the S&P, whatever, it's pretty flat, the Nasdaq pretty flat. Bond yields are up 20 basis points. That is a huge change. The euro went from 108 to 111 as of, right now as we're talking. That's a big, big change. And whether the bond vigilantes, so to speak, it's just a symbol, but whether that is something that influenced Besant, I really don't know. I don't know how long that will work, but the impact of all these events is that we've basically damaged the credibility of the United States. And whether that's with foreign buyers, with domestic buyers, it's all the same pool. And that's what those price signals are telling us. And it's a really, really important price signal. And as I'm looking, gold is ripping to 31.62 an ounce and trying to make an all time high. That is a very, very worrying signal. And that's what you should be really focused on, trying to pull something from all this chaos and noise.
One of the other narratives that's been floating out there is this attempt to sort of sane wash what the Trump administration is doing from a strategic perspective. This idea that if you impose the tariffs, you drive yields down, and then like you can refinance U.S. debt basically at a lower interest rate. Did that ever sort of ring true to you as a strategy, or was that always a little bit out there from your point of view?
I don't think anyone credible believes that. I mean, people look at his behavior, and there's always going to be people surrounding him trying to paint this as, you know, 5-dimensional chess. Like once you reach enough dimensions of chess, it's just like you're a moron. It just turns back in on itself. It's like a black hole. Um,
Yes. The
so yeah,
the
I'm in.
I love that. The fifth dimension is dumbass. So it's the dumbass dimension. That's fine. 5D. 5D chess, everyone. Well, so okay, so what does that mean then practically for the people who are listening? Like, how are they going to feel that in general? And is there any putting the genie back in the bottle? If, for instance, 3 months from now, Xi Jinping and Donald Trump are sharing a piece of chocolate cake, and the tariffs come off, and trade deals have been renegotiated, like, can this change quickly, or has something irrevocable been broken?
Well, the thing that's been broken irrevocably, which was already breaking, and we've talked about this, is that we're in a volatility spiral in all senses of the word. And we've been talking about this for several years now. And I think events are just continuing to confirm that thesis. And what that means is that just credibility is breaking, authority structures are breaking. And now we're really seeing it in such a tangible way where the president of the United States is basically engaging in the biggest pump and dump scheme in American history yesterday, while promoting, shower heads and uh, doing all the things that he's doing. Um, the genie is increasingly out of the bottle, and I think no matter what happens in terms of, oh, we're going to get serious now and we're going to strike, like those are fundamental policy things, and we could talk all day, and I'm sure you've covered a lot of this with Marco, sort of the fundamentals of what could happen, but ultimately it doesn't really matter. What matters is that the credibility is damaged, and once that's happened, it's extremely difficult to reverse that. And there's no sign that any of this that I see is reversing or is likely to reverse. It looks more like it's accelerating. Who's reining him in? Whatever forces brought him into power appear to be still strong. People seem to be kind of enjoying this, or at least some large segment of the population is kind of enjoying all this. And I think that's the reality, that as an investor, as someone taking care of your wealth, your business, your family, you have to take that into account as you're anticipating what's going to happen over the next 2 or 3 years.
Yeah, I take your point on the stereo being off that we talked about earlier, but to the extent that the music is still on, I think there is still a very large portion of the US electorate that believes exactly what you thought, that is cheering this on, that is happy to see action. It doesn't matter if it's crazy action or if it's bad action or if it's long-term damaging. It's like for the last 4 years, it was Biden and it was Sleepy Joe. Nothing was actually happening. Now things are happening, and he's giving them a positive vision, even if, to you and me, it seems demented. Um, Yeah, those people are still like you probably saw like earlier in the week, like retail investors like were buying up the dip. Like they didn't care at all about any of the market uncertainty. Like that, like that's at least somewhat of the music. And by the way, listeners, I'm not, I'm sure not all of you are keeping pace with everything. The thing that Rob said about showerheads is that President Trump signed an executive order to get rid of restrictions on water flow through showerheads. In his words, because he has trouble washing his hair with these low flow efficiency shower heads, which is an image I really don't feel like going any further down the rabbit hole with. So we talked about bond markets. Um, talk to me about the dollar. You've been saying for a while that that you thought the dollar could weaken. I've actually been skeptical. I've been in the corner being like, really, I don't know. Geopolitical bro is like, I think dollar maybe strengthens, but it's weakened. Has it weakened for the reasons that you thought it would? Do you think it has further down to go? And what does that mean? So we talked about bond markets. What does the weakness in the dollar tell us?
Well, the weakness in the dollar is telling us that the US is losing that role as the nexus of safe haven flows. And that's kind of getting to the heart of all of this, which is once you lose credibility, once you lose the perception as a reasonable, rational, safe place, then at the margin you begin to erode that position that you held. And previously, like investors were always content to hold dollar reserves because you know however how crazy it got, like oh that's just America, it's just how it is. Like we're reaching a tipping point where I think that's starting to fundamentally change. And there's a lot of reasons for dollar flows. Like one of them is just the huge overvaluation of U.S. risk assets relative to everything else, sort of starting to unwind. So there's a lot of factors we could pick out, but that's really the big one. You know, similar to the point I made about treasuries, the snapshot 10 days ago versus today. The U.S. like the euro, even though nothing fundamentally has changed in the European economy or outlook or anything, the euro just gained 3% on the dollar and is trying to break out to a new, multi-year high here. Um, that's a really important takeaway. I don't see any reason why that would reverse. Um, I think it's confirming this sort of view, which is that you want to be diversifying out of the dollar. You want to be diversifying into foreign currencies of strong nations. Look at what the Swiss franc did in the last week. Full disclaimer, we have a lot of Swiss franc exposure, with our clients. I think that validates that thesis. So yeah, I mean, uh, so far the dollar weakness story has really, I think, been playing out.
Yeah. I was listening to Odd Lots on one of my many flights and delays over the past 36 hours, and they were making a really interesting point. They were talking about how so much of the focus on tariffs has been about the deglobalization of goods. And I confess, as somebody who does geopolitics for a living, like geopolitics of goods makes more sense to me. Like physical things and actual geographies, like that's where I really feel like I know things best. And they talked about though about how now we're moving towards deglobalization of capital. That's a very different sort of thing, and what could that actually mean sort of in the long term? And to your point, it's not something that's gonna happen overnight. Like, it's not like everybody's gonna run for the exits tomorrow. So the fact that we're giving all these headlines or market up, market down, but have we entered this phase of the deglobalization of capital, and we're gonna get these retreats to some of these different capital markets? How do you think about that? Because I hadn't quite articulated it to myself yet. Maybe you were already there.
Well, it's funny because we take globalization of capital such for granted because that's been our reality for our adult lives. But if you look historically, goods have always been much more globalized than capital has. Like even through the whole second half of the 20th century, like it took a really long time for capital market liberalization to happen, even as good, globalization from a trade standpoint and actual like containers moving around was gathering apace. So I think there's some complacency around that. Globalization of capital is uh, is a much more sensitive thing because capital is ownership. Capital is, it's one thing to ship a box of products to a country and have a relationship in that way. It's another thing to say, hey, we're American investors. We're going to go own Chinese equities. We have an ownership stake in this Chinese business operating in China, doing business there and producing things on this land, or vice versa. And we forget that, we always think of it as just digits and stuff on paper, but that's a very, from a legal standpoint, from a just fundamental standpoint, it's a much more sensitive thing. So as that starts to unravel, that's arguably a much bigger factor. And certainly from a currency standpoint, it way outweighs the impact of trade, on currency movements and things like that, because the flows are just so much larger, and the volumes are so much larger.
Yeah, it's a good example of how politics also trumps, if you'll forgive the unintended pun, a lot of these different things. Also, on my flight yesterday, I was rereading Lords of Finance because I was thinking about the 1920s and the 1930s, and in the introduction, it talks about Norman Angell and about how this idea that the world had become so interconnected economically that war didn't make sense, so there would never be war again. Of course, then World War I happens. But one of the anecdotes that they point out was that Lloyd's had insurance contracts with German ships, and they made this presentation to the British government that said, "Well, if you go to war with Germany and you sink their ships, we are legally and dutifully bound, we are legally bound to compensate the Germans for the ships that you're going to sink because they have insurance contracts with us." And of course, that was another example of all the interconnectedness. But to your point, that's not what happened when war broke out and when things actually got real. A lot of the European countries were just selling assets for as cheaply as they could to fund the war effort, and in some sense, that's really what sets the United States for where it is today. I say that just because I think the base case is still that Trump wants a deal. He says he's waiting for Xi Jinping to call him. He's been talking about trying to get some kind of deal with China the whole time, and even as he was threatening tariffs, 15% of me, as I said, was thinking margin call and Jeremy Irons, but the other 85% and the part that was speaking in front of audience was saying he's bluffing because if he does anything different, he's going to completely blow off both of his feet and the feet of the entire economy too. But when you start to get to those places where the choices are narrowed a little bit, maybe things could get bad. Do you see that kind of narrowing of choices coming, especially with the US-China relationship? Because those are the two biggest countries, the most important countries, the biggest economies in the world. If they're really going to decouple this violently and this quickly, we haven't done this before. We certainly didn't do it during the first Trump administration. Actually, interconnection between the economies rose. It sucked for Huawei and it sucked for some American farmers. But generally speaking, actually the interconnectedness of the economies increased. So I don't know, take that whatever direction you want.
Well, it's an interesting question because the US and China are two of the biggest places that really don't have strong capital links. They have huge, trade links, as everyone knows. But the reality is that Chinese capital is tightly controlled, um, and US access to Chinese markets is tightly controlled. I can't tell you what a pain in the ass it is to arrange to get access to onshore Chinese equities for our clients. And it's rare. It's extremely valuable and it's worth going through and doing, but it's not something that the average investor is picking up, any sort of product that you can get in a retail arena and getting access to China. So those connections have already been severed to a great extent. So I think that, um, it's a very unique relationship because we're really talking about a trade relationship in many ways, but at the same time, as many people have pointed out, direct trade between China and the US has actually gone down, um, as a percentage since the initial, Section 301 or whatever tariffs were introduced in 2018. I think, it used to be 20% of China's trade went to the US and now it's 17%, or I don't recall the numbers off the top of my head. But it's not like the US and China direct trade relationship even is so huge. It's all these intermediaries. It's simply the fact that you have these two giant economies. US is 30 trillion, China's 20 trillion roughly, depending on how you count. And that's overstated, but whatever, we'll just call it that. Like that dwarfs anything else except for the European Union considered as a whole. Like those are the only three regions that matter. And one of them has this huge deficit, one of them has a huge surplus. And that's filtered through all the complexities and intermediaries. And they don't have those capital connections with each other really. It's just that, their tentacles in either direction in all these intermediary countries. And then how do they figure that out? I'm not sure there's an easy way to an easy way to do it. I think any deal, as you point out, has to be sort of for optics because other than making policy-wide changes in the US or in China to close those deficits or surpluses in either direction, I don't think there's a mechanism that you could use. You need like a million scalpels in terms of policy to try to, cut out the individual imbalances between the two.
I'm sure that all of the 10 Japanese people who listen to our podcast wouldn't have the temerity to object to your characterization of those three economies. Where does Japan fit in there? Because I think of Japan as in that club, but maybe I shouldn't think of Japan in that club with China, the US, and the EU.
Well, I don't have the number in front of me, but I think Japanese total GDP is like 4 trillion, 5 trillion. So they're big. They're like Germany. They're the same size as Germany, roughly. But there's no rest of the EU around Japan. Japan, as much as I hate to say it, when we do our macro analysis and I have all our tables and stuff that I am like, breaking it out, I put Japan as like an appendage of China. So don't tell the 10 listeners, but they're that's how they stack up.
Yeah, we'll certainly keep it from them. Forgive me for maybe this is a naive question, but so let's say we're moving towards deglobalization of goods. Let's say we start moving towards deglobalization of capital. One of the things we often talk about here, though, is that the international opportunity is maybe better than the domestic opportunity in the U.S. and going forward. Are U.S. investors even going to have access to those markets, though? Like if we're getting to these sorts of problems all over the world, and if capital is deglobalizing that way, does that necessarily also mean that, okay, Europeans will keep their money in Europe and invest in European companies, and Americans will keep their money in the United States and invest in their companies? And the Chinese, I think, hope desperately that the Chinese will keep their money in China and invest in Chinese companies. Is the prospect of international diversification disappearing, or is that not one of the follow-on effects of what you're talking about?
Um, I think you have to break it into two parts. There's FDI, foreign direct investment, which is actually going and building physical stuff in a country. And then there's portfolio investment, which is just owning securities. So you'd have to get to a really, really bad place for the portfolio investment side to be cut off. Like it's already cut off in many ways between the US and China. As I mentioned, like US investors, it's easy to buy Hong Kong stocks. And in many ways, that's kind of China's way of dealing with us in a way that's a little more hands off and through an intermediary. Um, but you can't get onshore access and there's all complexities. But other than that, for the most part, you can go and buy equities in most places in the world that are of size. Um, that's probably not going to change anytime soon, even if things get really bad. Like when we talk about capital controls and sort of restrictions and Europeans investing in Europe, we're really talking about FDI, meaning like if a European company, if Dassault Systems wants to build some sort of facility, they're going to be encouraged to build it in France. Or, if Bosch is going to build something in Germany, like that's much more politically sensitive. I think that's clearly where we're going already, to a great extent, with some exceptions. But that's in total terms, it's not huge relative to the amount of portfolio investment. And most people who are wealth holders, they're not going to be going to build a factory. We're talking about owning, business participations in businesses, equities in these places in a portfolio context. So the opportunities are still there.
Okay. Um, two more sort of things we need to check off on our list. Just by coincidence, we didn't design it this way. We had a CPI release today, down 0.1%, which was a little bit surprising. I will say when you look at the breakdown, its energy is down 3.3%. Everything else is up. Food is up 3%. All items less food and energy 2.8. The overall figure 2.4. So really, like obviously, the Trump administration is going to do a victory lap on inflation lowering. That's really just energy, and energy is down because people are afraid that we're going, to your point, into a deflationary spiral, recession, potential Great Depression. Markets are convulsing. Brent crude is touching around 60, even below 60 as we're talking here. So there's the inflation thing I wanted to throw at you. And then also I know that you've been doing some company level analysis that you wanted to talk about too. So we can pick either one first or you can meld them together, however you want to do it.
Yeah, let's take them one at a time. So on the inflation print, I think the kind of glib takeaway is don't pay too much attention to the data right now because it's a mess. So there's two factors going on that are screwing up inflation. The first is all of this tariff nonsense, all of the chaos of the last couple of months is screwing up these seasonality adjustments because you're seeing uh, sort of purchases of goods in times when you don't usually see them. So, for example, we know there was a big bolus of companies buying inventory in January in anticipation of tariffs coming, especially around Canadian border, Mexican border, those sorts of things. That is really screwing things up because now that's getting unwound because you're lapping that. Companies already pre-bought, so that would have an inflationary impact in January, a deflationary impact afterwards. So there's a lot of mess around that. Um, the other thing is just in terms of pricing, and I think this is an important takeaway. Just thinking longer term rather than just the last few months is people are going to be talking about inflation, and I've talked about inflation and long term inflation expectations being reflected in those bond yields. The thing to remember is that inflation not only is likely to be higher on average, but the volatility of that inflation is likely to be higher, as you go along the way. And if you look in the 1970s, inflation didn't it doesn't just go high and then stay high. Inflation was all over the map. And that's very likely to be the experience that we have because again, the only certainty is uncertainty. So when you have these cases where everyone's loading up on goods because they don't know what the heck is going to happen with tariffs, and then they're puking out inventory because they need to unload it, and they're taking a bath on prices. As you have that sort of dynamic, and as inevitably we go into a recession, whether it's now or at some point in the next year or two, like very likely we could have a very bad recession at some point. We've seen it many times in the past. All the pre indicators are there, and you could see inflation come down and come down really quick. Uh, but all of those things are sort of temporary phenomena. You should expect that to be more volatile and to average higher over time. And those are really the things to take away from that. On the company specific side, there's really two observations from this week that I think are really important to take away from these tariff announcements and what companies were saying about them. The first is, again, to hammer this point, uncertainty. Um, the companies that came out and actually have been starting to report because they're not on the normal calendar, uh, so primarily retail companies, they're not necessarily having terrible results, but they're all withdrawing their financial guidance. So this was a big deal. Delta Airlines withdrew their financial guidance for the year. Now they have no guidance, and basically said we're preparing for a potential recession. Um, CarMax reported this morning, and the stock was down primarily because they had these financial projections, and they took away the date. They said we don't know when we're going to get there. Like hopefully in the future we'll hit that number, but now we there's just too much uncertainty. And for those who don't have the context here, investors like guidance because it gives them something to anchor on. It gives them certainty. It lets them put a valuation on some kind of expected number in the future. So companies always want to give that, and they want to be conservative, and then they want to beat it. Like there's a little game to this. But if you're reducing that, that's a very bad thing. It means that there's not even enough certainty to put any sort of conservative forecast out there that you can credibly beat without too much trouble. And that just underlies this notion that, you know, it's bad for investment, it's bad for corporate decision making. They don't know what's going to happen, and that's not good for growth. So that's the one takeaway. The other takeaway was something that Walmart said that I thought was really, really important when you're thinking about individual companies and what's going on. So Walmart came out and they said, this was before the big turnaround, but they said, whatever happens with tariffs, we're going to eat it. We're gonna use this as an opportunity to lead with lower prices and take market share. And that's really important because I think we were talking the last time about Walmart and how their margins were sort of really off the charts and its valuation was 2 standard deviations away from long-term average. This is a very interesting trend, and I think what you're starting to see is sort of champion companies, really strong companies that have elevated margins, and a lot of companies, as we talked about, are coming off a period where their margins have been really high. I think you're gonna see them eat inflation and take an approach where, now is an opportunity to harvest, and cash that check that they just got and get market share. So this is really important because it's not good for margins at all. Because it means that the weak players who don't have as good margins are going to lose share, or they're going to have to cut price to protect their share. While the big players give up share I'm sorry, give up margin to get market share. And I know that sounds wonky and annoying, but the takeaway here is that companies have been extraordinarily profitable in the last 12 months. And, a lot of input prices had been in the floor. Uh, Margins were super elevated on a price to sales basis. Lots of companies were just off the charts because they looked really profitable and it didn't look like on a PE that expensive to buy them. All of that appears to be moving in the other direction, and that is a huge implication of all the things for the S&P 500, for equities. That is probably the thing that no one's really thinking about in all this, but it's probably the most important one, is they've signaled, "We're gonna eat. We're gonna eat this. We're gonna go after." Um, so that's the takeaway I would have on that side.
That also sounds like a music metaphor to me in general, but, I guess not, because I mean, that sorta sounds like the music is starting to fade there too, don't you think? I guess it's not the same context, and it's important to be consistent with metaphors, but you start poking around, it sounds like lots of things that were going have suddenly reversed themselves.
Well, that has been some music because, you know, American corporations have been living high off the hog for the last 4 years. First, it was stimulus and government deficits blowing out, and then it was, they had increased their prices, and then COGS fell through the floor. So they've been sort of milking the customers, milking consumers, so because there's always this delay to have, you don't cut prices in many industries, like, that just doesn't happen, at least not right away. There's some discipline. It's like a Mexican standoff, right? The industry's there. Everyone knows what the pricing level is. You know that aluminum prices or whatever the heck is the cogs of what you sell have fallen through the floor, and everyone's kind of looking around like, are they going to cut prices? We're not going to do it. It's a cartel dynamic, so it doesn't happen immediately. So that's what we're coming off. It's like the Wile E. Coyote moment, where now Wile E. Coyote is looking down. He sees there's no cliff below him, and I think you're gonna see that start to play out, and that's really important in terms of ending the music that we've really seen since COVID and all of the government funds that just got sloshed into the economy after that point.
Okay, well, I'm not sure if I feel better or worse, but I've been directing us here for most of the conversation. Is there any direction you wanna take it in or anything that we've left unsaid thus far?
No, I mean, all of the geopolitical stuff, I think you've covered in some detail recently. I mean, I guess what I would come away with is the outlook is not super encouraging in terms of a pure US standpoint, and in terms of a, US companies just minting money for no good reason standpoint. Um, the backdrop to this is all this volatility seems to be accelerating sort of innovation. I've been talking with Tomas. You don't know this because we haven't had a chance, but Tomas and I have been on the horn, and he is, hearing a lot of activity in the mineral sector or the recycling sector. Like, there is, and this isn't just building factories because, oh, United States, we're going to onshore everything, but there's a lot of uh, galvanization that's happened. No pun intended on the mineral side. Uh, that's pretty interesting. So, from an innovation standpoint, things are just getting more and more interesting, and that's the positive side of all this crazy change and stuff that's scary. Is it does increase the opportunities there, and you know that's where I'm trying to put my head at when I don't have to be, trading, on behalf of clients at 8 p.m. because Trump came out and said something.
Yeah. Oh, you also mentioned, I forgot to say, Delta Airlines withdrew their guidance like literally 15 minutes before Trump announced the tariff pause. So it was so weird. I had Reuters up that said Delta withdraws guidance. And then on the other screen, Delta stock was up 15%. And I was like, something here doesn't make sense. Like you would think withdrawing that. That was when that was actually how I learned that he had withdrawn the tariffs. So like, why is Delta up 15% on withdrawn guidance? And there it sort of was. And yeah, I hear you on what Tomasa said. I've sort of been hearing, I mean, something similar, but maybe not as positive, which is to say, um, there is space for innovation, and those that are really at the bottom and who have sort of access to things that are going to be important going forward, or things that we've outsourced to China, and now that we need in quick order, like they stand, I think, to succeed and get lots of investment. And then big players, whether it's your Walmart, so like okay, like we can say that their margins are going to get worse and they're going to eat inflation. But the big players are fine. Like they will weather the storm. To your point, nobody's going out of business. Walmart and Costco are not going out of business. Like Nvidia is not going out of business. Nvidia, by the way, you probably saw, got the Trump administration to take down a restriction on some of its chip exports to China. It's the small to medium sized businesses and entrepreneurs and the established businesses in those areas that seem to me to be under the most duress. And it's funny because at least in my own, this is anecdotal, but at least in my own experience, those are also the people that um, skewed more towards voting for Trump and supporting Trump. And it seems to me like his policies are actually the worst for them because we're sort of at the point in the economy where you can either scale up, cash out, or specialize. And to your point, like Tomas and those types of guys, they're specializing. Your Walmarts, well, they can just scale up and they're going to scale out even more. If you're in that small to medium sized space, like what can you really do? Like I was the guy sitting next to me on the plane last night, small sized air conditioning company, like maybe 10 million revenue a year. Talked about how PE firms are just eating up all the different conditioning companies. That there aren't a lot of small size air conditioning companies anymore, and that he's gotten multiple offers from these PE firms. He hasn't taken them in part because he's seen PE firms go belly up. It's not like they just cut you a check for $10 million with all these strings attached, and then they go away, and then how are you supposed to get it? But and I've seen that in the ag space too. It's that small to medium size entrepreneur, which in some ways is the lifeblood of the American economy, like the American economy that Donald Trump talks about, the thing that he romanticizes. Like those are the people you want to help, and those are the people who are arguably like most wounded by uncertainty, by volatility, and by protectionist policy that is not also supported with fiscal policy to get them through the struggle, because those people don't have the cushion or the resources, I think, to get through here. That's one part of this that has been bothering me a good bit in the background.
Yeah, I think it's a really good point that you bring up, and I know you're gonna go speak with some, agricultural, business owners in a few hours, so it's really apropos because, like, if you look historically, the the parallels are not particularly encouraging because the problem is, as you point out, it's not even the environment in terms of demand that is so difficult for small to medium businesses, it's the volatility. And especially if you're talking about small to medium businesses that deal with physical stuff, they tend to have less access to capital, which means they have less of a sort of cushion to manage when margins go against them. Um, Businesses that have a lot of working capital, where working capital is swinging back and forth, especially inventories. Like I'm thinking about distribution businesses, like the air conditioning company is a perfect example. That's a terrible business to be in right now. Like I hate to tell it. Like I hope this guy isn't listening, but
He's not, don't worry. He was actually
yeah,
a little annoyed. He kept on telling me, "Don't worry, you're gonna make your flight." And I was like, "Bro, I'm probably not gonna make my flight. Please stop telling me that things are
false
okay."
optimism. Come on,
Well,
that's not very nice.
it also felt like karma because I feel like I often, if Megan is listening, hi Megan, I feel like I often give false optimism with her and our relationship. Right? Like, of course the baby's gonna go back to sleep. Don't worry. Like she'll self soothe. It's fine. It's fine. Anyway, sorry. Go on.
Well, rather than give false optimism to the small business owners of the world, I think that's really something to think about and anticipate is just the volatility of inflation, the volatility of especially sort of goods prices and materials prices as all of this sort of inventory build and puke out happens. It's going to make it so difficult to manage your working capital, to manage margins. I mean, you saw so many like I know someone who had a family business that did steel distribution, like steel kind of product manufacturing uh, in Massachusetts, an older guy, and he took over the business in 1979. And within 2 years, they had to shut it down because their margins just got so creamed because of the volatility in pricing. And if you're holding any sort of working capital, any sort of inventory, it's just really hard to manage that in a way that's effective. So building those buffers as much as you can, more than you think you need, trying to be opportunistic. Like if you play it well, you can ride the storm, and you have to be able to have the buffer to sort of lean against the wind though. You have to be replenishing inventories when everyone's puking them out and there's concern that we're going to the next depression. And then when, the volatility is moving the other way, you have to be much more cautious. But that's just not human nature usually. We tend to be pro-cyclical, and that's why a lot of small business owners in particular get screwed and shut down in periods like this.
Yeah. Okay, before we leave it, I've asked you this the last couple of times at the end of the podcast. What is the mood on the Parisian streets? How are the Parisians doing? Are they the same? Are they aghast at the developments? Like, what's the mood in Paris? I know it's probably getting into summertime, or at least close to it. So maybe the weather's getting better. Like, how's it
I
going?
don't I don't I don't know, man. We're going down to visit my in-laws this weekend, and I've already been pre-warned that I should be prepared for many, many questions. My mother-in-law has already said, like, just tell Rob we really want to sit down with him for a few hours and understand what the hell is going on here. So I said to Juliet, I was like, damn, I better really brush up my French ahead of this marathon. So yeah, they're interested. They're befuddled, I think is the uh the best way to describe it. But yeah, definitely still a topic of conversation.
And has Le Pen inched her way into that conversation with her ban on running for president, or is she just kind of like, like more from the circus?
Yeah, not so much. I mean, the people I interact with they're not Le Pen supporters,
Shocked
to
to
be
hear that.
honest. Yeah, I know that's surprising. I think there's a perception that, you know, it was probably a little unfair that she got banned. Like that was probably more than was justified. Would be my sense of the consensus, but that's a little hard to say. I think people have been so distracted by what's going on in the US that it's not nearly gotten the press that it might have otherwise.
Yeah. Okay. Interesting. All right. Well, we will leave it there and we'll check in with you. Or listeners, we're probably going to move to a bi-weekly cadence. That is our new plan rather than scrambling every week. So we'll hear from each other 2 weeks from now, unless something crazy happens in the next week, Rob. We're here to give the people what they want. So
All right, man. Fly safe.
thank you so much for listening to the Jacob Shapiro podcast. The show is produced and edited by Jacob Smulian, and it's in many ways the Jacob Show. If you enjoyed today's episode, please don't forget to subscribe, rate, or leave a review. It takes just a couple seconds of your time, but it really helps us. Also share with a friend. If you're interested in learning more about hiring me to speak at your event, or if you want to learn more about the wealth management services that I offer through Bespoke or at Cognitive Investments, you can find more information at jacobshapiro.com. You can also write to me directly at jacob@jacobshapiro.com. I'm also on X for now with the handle Jacob Shap. That's Jacob, SHAP, no dats, dashes, or anything else, but I'm not hard to find. See you out there.